Welcome to Inside the Practice, your go-to podcast for stories, tips, and insights from professionals helping dental practices thrive. Hosted by Alan Hollander and Sarah Boylan, and sponsored by ePractice Manager. Enjoy the episode.
Hi, and welcome to Inside the Practice, your go-to podcast for expert-led discussion and actionable insights in the world of dentistry and its specialties. I am your host, Sarah Boylan. Our show is designed for dental professionals who want to stay informed, connect with like-minded peers, and take their practice to the next level. Today, I am so excited to be welcoming back my own CPA and friend, Elliot Tracy from Soren CPA Group. With over 16 years of experience working with medical and dental professionals, Elliot brings extensive expertise in helping practice owners improve profitability, streamline operations, and build long-term financial success. He is known for his proactive approach and practical insights that help practices thrive. I've had the pleasure of working with Elliot directly for several years now, and it is truly a pleasure to have him back on our show. Elliot, welcome.
Thank you, Sarah. Yeah, great to be back.
So tell us a little bit more about your experience.
Yeah, so as you'd mentioned, I've been working with dental and medical professionals for about 15 years. I've been in the accounting industry since 2008, 2009 was when I started my career. Really pretty early on, started focusing with dental and medical, helping them through, all the things that you kind of mentioned, the proactive tax planning, really some general cash flow, business planning, and just trying to help them, keep more money in their pocket.
That's awesome. Well, like I said, I think you and I think I met you back when I was president for the Oregon Dental Executives Association. That was just a hot minute ago, quite a few years ago at this point.
That was a while ago, yeah.
Well, I've loved working with you all these years, and I really appreciate you coming on to educate our audience about what's happening with this big, beautiful bill. Sounds like there's a lot of changes that could be potentially really affecting some of our dental practices. Starting right off the bat, tax relief and practice investments. Can we dive into that conversation?
Mm-hmm.
It sounds like there is a 20% small business income deduction. Are there ways dentists can plan strategically to make the most of that?
Yeah, and so when we got this new tax law, or not necessarily new tax law, but a continuation of the tax law that we've had since 2017, 2018. I think we kind of expected that we would see something really similar, given that Trump's first time in office, this was his tax law that he had passed. And so, an easy assumption, which is pretty much what we got, was a continuation of a lot of the provisions for small business owners. And the big one was this qualified business income deduction, this 20% deduction that, S corps and partnerships and single member LLCs were all able to take advantage of. The biggest issue over the last couple of years with this, especially as it pertains to dental and medical professionals, has been the ability to actually take it. So there were some income limitations that would kick in for married filing joint taxpayers around $350,000 to $370,000, depending on what tax year you looked at. And that limitation's still here, but it's been expanded a little bit. So the biggest piece was, assuming, we're talking about a year or two ago, that, like I said, that phase-in was right around $370,000, $380,000. And if your taxable income hit about $480,000, then because of the industry they're considered a specified service trade or business, they'd lose out on that deduction. And so with the passing of the big, beautiful bill, it expanded that slightly. So instead of that phase out kicking in after $100,000, it now kicks in at $150,000 for married filing joint individuals. So if you have a practice that has net income and you materially participate and you're in that business and you have qualifying income, mostly all practice owners will, there's a potential for a higher deduction than they've generally seen in the past few years. And there's a really good chance that they weren't seeing any deduction at all because they were over that income limitation. And so now that limitation, the top end of it's about $540,000 of taxable income. And so I think with the passing of the bill, we're going to see quite a few more professionals actually receive this deduction than we have in the past few years.
That's awesome. Well, that'll be super helpful.
Yeah.
So
yeah.
my favorite conversation is always capital equipment, because that's all, buying things for the practice that's going to help improve patient care, innovation, R&D, all that stuff. So I saw that there's 100% bonus depreciation, and it sounds like it's a great opportunity for practices investing in new equipment. How can practice owners use that wisely without overextending themselves?
Yeah, it's a great question. And, again, like as we talk about how tax law was for the last few years versus where it is now as of today, we saw 100% bonus about it would have been 2018, 2019, and then it slowly reduced to 80% to now we're at 60%, or was at 60% bonus depreciation. And so this new bill kicked it back up to 100% bonus, which for those that might not know, all that really means is if you buy equipment, you can expense 100% of that cost in the year that you acquire that equipment. And we've had significant discussions around equipment purchases. One, like you said, like over leveraging. Do you need to go out and finance this piece of equipment? Is this something you can pay for in cash? Which is a lot of discussion we have because of the timing of the depreciation versus when the actual debt payments are made, especially when you have 100% bonus. So it's a big thing that we talk about with practice owners. If you're going to go buy $100,000 worth of equipment, take it all in the first year, you still might have 5 years of debt payments to pay off that piece of equipment. So you get a deduction in year number 1, but then you have 4 more years of these liabilities that you just kind of need to prepare for effectively. And it's one of the more common discussions I have outside of like, how do I save taxes, or what's a smart way to save in taxes, is this discussion is, do we take the 100% bonus knowing that we have these years of liability left, or do we spread this out over time? And what bonus does is it gives us the ability to be flexible in that decision, whether it's a big tax year and they're in the highest tax bracket, and so it makes sense to take those deductions. Also with, our last topic conversation was the qualified business income deduction. This is one of those big things that we use to help get taxpayers eligible to take that deduction so that we can get them back into that range where they can receive that 20% deduction if they were phased out without it, which happens quite a lot in a lot of the tax planning that we do. They'll be phased out under one scenario, but if we buy some equipment, now all of a sudden they are able to get that 20% deduction. So, depending on what state you're in, at the federal level, you have you might receive a benefit of 30% off your taxes or somewhere in that ballpark. That number goes up significantly when you become eligible for this qualified business income deduction. So we like to use the purchasing of equipment as just one way of helping them become eligible. And that 100% bonus really is a great aspect to that, because now we might be able to get them a much bigger deduction where they wouldn't before. But it's still really important, as I mentioned, to have that conversation of, if this is being financed, you have to understand there's 4 years, as much as 4 years or more of additional years of liability that we have to be able to plan for, with the deduction happening in the first year. So yeah, it's a give and take for sure in terms of both those conversations.
Yeah, no doubt. But it's nice that they've got a resource to be able to come and talk to you about that, right? So you guys can do that planning. Okay, so looking at our workforce a little bit here, we have had a lot of changing dynamics. What kind of financial or tax incentives might help dental offices attract and retain great people?
I think a lot of the really traditional things that we talk about are still there, like 401k plans. Those are generally the best employee retaining tool that we have. especially if you have some type of vesting schedule to where you're encouraging them to stick around at least 5 years so they can get all of the money that they're putting in on your behalf. They being the dental office is putting in on behalf of its employees. And a lot of that's done with those vesting schedules. The 401k is a great tool for that. Obviously continue paying for continuing education, paying for opportunities for them to learn becomes a huge piece. Consistent. I don't know if I would say consistent bonuses, but just the consistency of having cash incentives out there is another great tool. One that has kind of flown under the radar to some extent is the student loan interest assistance. So a office, and again, you can't discriminate amongst employees, but you can offer the same benefit to all employees as you can pay up to roughly $2,500 per year on their behalf towards their student loans. And that's one of those ones that could be a great planning tool if it makes sense for your office and there's the ability to do it. Health insurance, always another big one, important, being able to offer all those benefits there. And there's a lot of ways to do that outside of just the traditional go out and find a group plan and offer it, because that at times can be expensive depending on the plan. But HSAs are become extremely popular and a really great tax planning tool, and putting money in employees' HSAs is another way to help retain that employee. So there's a lot of benefits out there, and obviously, you could do every single one of them, and it could become very expensive over time. But finding the right ones based on what your employees really want and need, I think is the key. But I would say the 401k is a no-brainer. I think it's really important to have that within every office, some type of retirement plan opportunity.
Yeah, no, that makes a lot of sense. And having strong benefit packages is definitely helpful. And if the offices can help save on the tax side of things too, then it's a winning strategy for everybody. Okay, and finally, some of these offices are exploring new care and payment models these days. Things like membership plans or flexible patient financing. What should dentists know about the financial and tax side of those innovations?
Yeah, I think the big, traditionally you hear about, these merchant fee services where they basically, it's almost like a credit card where, the balance gets paid in full and then the employee is paying it off as they go. I think the big ones with that most offices don't realize is there's obviously a fee associated with it that they're charging, not the patient, but charging the office to basically take that over. So, that gets discounted, but they do collect on the front end. And I would always argue that, cash is king in terms of the sooner you can collect, generally the better shape your office is going to be in when you don't have those collection issues. Providing opportunities to patients are great. And obviously being the number guy, we talk a lot about what should be in your accounts receivable on a monthly basis. And we generally say you don't want to see more than about 1 month of your average collection or production, within that number. If it goes over that, you're potentially having some issues collecting. And so, these different flexible options can be great as long as it's consistent and you're able to collect more on the front end versus it, taking 6 to 9 months to collect on something. Yeah. But the membership plans, I've seen those pop up more and more. They were very popular, and I don't know if I would say they've slowed down, but I don't see a ton of new ones as of late, other than those that are done within an office. But I know they are something that's very common and a great way to have a patient who maybe doesn't need a ton, and that might be the right fit for them. Yeah.
Perfect. Well, it's something beneficial for doctors to be able to offer patients.
Yeah.
So this one big beautiful bill was full of stuff. Yeah. What other things do you feel are important for the doctors listening to know about?
Yeah, right off the bat, one of the first questions I got outside of the 20% deduction. Like that was one of the big questions right away, and bonus was in that conversation. I did get a lot of questions about the overtime rules, because obviously within an office, there's the potential for employees to receive overtime depending on, what that work schedule looks like, how many employees they have. The big what I mentioned, the dentists who were asking about it, was that it really doesn't impact the office at all. And I think there was this thought that it would somehow, there'd be some impact to where they'd have to do something administratively that they weren't prepared to do. And I guess that would be true in certain cases if you were doing your own payroll in-house, but most of these payroll providers, whether it's, throw out any name out there at Paychex, ADP, Gusto, like any of these third-party payroll providers that you hear of, they've really taken on the administrative burden of that piece and the reporting aspect, because it's all a reporting that goes on the W-2 for the employee, and then they'll see the benefit on their personal return. But I did get quite a few questions about that initially, because it's like, oh my gosh, what do I need to do now with overtime? It's really nothing other than just make sure if there is overtime, you report it, that It is overtime, so that it gets treated properly for the individual. Another one that hasn't had a lot of conversation, but I think could be a really interesting or really great planning tool for somebody who might be towards the end of their practicing life and looking to potentially sell their practice, is the qualified opportunity zones. What essentially that is if you have, and it doesn't necessarily have to be the practice that gets sold, it could be any individual investment that you have, but if you have a significant amount of capital gains in a specific year, you can roll those funds into a qualified opportunity zone, which has to be classified that way for federal tax purposes, and they get to defer dollar for dollar that amount of gain. So if it was $100,000, you roll $100,000. So you might have received $500,000 and your gain on that was 100. All you have to do is roll $100,000 of that 500 in my example into a qualified opportunity zone. And in the year of the transaction, you don't pay any tax on the $100,000. Now, the important part is this doesn't go away. You do still have to pay taxes on it. It's very different from the popular example is a 1031 exchange, where you sell a building, you roll that into a new building, you don't pay any tax on it, and you don't ever have to pay any tax on it unless you sell that next building, or when you sell the building that you rolled into. So that's where it's very different. With this, you still will pay taxes on it eventually, but there are different step-ups that allow you to pay a little bit less throughout that process. And what has become really popular with these qualified opportunity zones is that if you hold it for more than 10 years, at that point, if you were to sell it after that 10 years, any appreciation you've had on that investment is tax-free. So if you have, in my example, $100,000 investment, and you roll it over, you had $100,000 investment, it's now worth $200,000. That $100,000 increase does not get taxed.
Nice. That's amazing.
It's a very cool planning tool, and these qualified opportunity zones are fairly easy to find for the most part. There are some that are harder to figure out exactly where they're at, but there is a map to know are across the US. And then there's these funds set up that will obviously say qualified opportunity zone fund on them. So those are where you're seeing those opportunities. It kind of slid under the radar, like I said, a little bit, but it's out there and it's available. The couple of the other things, I think, and it affects individuals who are in higher tax states versus others. So your California, your Oregon, your East Coast, some of the East Coast, and I forget exactly which one's up there because I don't do a ton of that. But those states, like New York is a good example, but those states where you have a higher personal income tax, the limitation on the amount you could deduct for state and local taxes, which included real estate taxes, has been limited to $10,000 since 2018. And now that amount has been increased to $40,000. So a lot of these states, you still have a way of paying your state taxes at the entity level, which, for many states, they call it like pass-through entity tax. Mm-hmm. So you can pay the tax at the entity level for the income that's generated on the practice. And then personally, you might be able to take more in state income taxes from your withholdings and the real estate taxes. So the last few clients I've looked at for this, and we've done some planning around it, they were deducting $10,000 each year for the last 6-7 years, and now they're getting $25,000 or $30,000. So immediately the savings has gone up just by the fact that they've increased that limit. And you still have the benefit of this pass-through entity tax, depending on what state you're in. So those are the big ones I've seen. Those are the ones I've talked about really the most throughout this process. And I think, individuals are definitely going to see some benefit with those items.
Well, that's very reassuring. I appreciate that as I'm staring down at my own taxes coming down. I'm so glad I have you to take care of me. That's great. Well, how do our listeners get a hold of you? What's the best way?
All of my contact information, obviously, on our website at Soren. You can find me there. My bio kind of explains, just like you had said before, like what I do, and my email and direct line is there. So definitely reach out to me that way. Email is usually the best way. It's kind of my to-do list for the day. So if I see something, I usually try to get back to folks right away.
Awesome. Well, Elliot, thank you so much. Really appreciate your time and your expertise being on our show today. If anybody in our audience would like to get a hold of him, definitely reach out to him directly. Please feel free to reach out to me. I'd be happy to connect you as well. And thank you so much for being on this episode of Inside the Practice.
Yep. Thank you, Sarah. Thanks for having me back again.
Thank you.
Thanks for joining us on Inside the Practice, sponsored by ePractice Manager. We hope you enjoyed today's episode.